Now, adjustable rate mortgages. I love adjustable rate mortgages. Adjustable rate mortgages get a bad rap from a lot of people, but it's a great tool if you know how to use it. You may hear it referred to as an ARM, and they typically come in three popular ways: the 5-year ARM, the 7-year ARM, and the 10-year ARM. Now, that first number that you see on the board here, the 5, 7, and 10, that talks about the initial fixed period of that interest rate. So let's use the 7-year ARM as an example. If I have a 7-year ARM, that means for the first 7 years, my interest rate is going to stay the same. At year 8 is when it's going to come up for adjustment. And that's what this second number is alluding to. The one that you see in all three of those is telling you how often it will adjust after the first change date. So if I have a 7-year ARM, it's going to adjust at year 8, year 9, year 10, year 11, year 12, all the way to year 30. And it's going to change annually on my anniversary date. Now you might be saying, well, why would anybody do that? Why would you want something that's going to change and you can't predict what's going to happen? Well, if you know that you're only going to live in that home for 3 years or 4 years, I would absolutely take a 7-year ARM. Or if you know, like right now, we're at a higher point in interest rates than we have been in recent years. If you believe, like I do, that interest rates are going to come down, you take the ARM because the ARM has a lower interest rate than the fixed rate. And the reason for that is the shorter amount of time a bank has to guarantee you the rate, that's less risk to them. The longer they have to guarantee you that rate, that's risky because they have to guarantee you that same interest rate for 30 years no matter what happens in the market. That's risky. Whereas if they only have to guarantee you to it for 5 years, 7 years, or 10 years, that's less risk. Less risk means lower interest rate. So if you know you're going to be moving soon, or if you believe that interest rates are going to come down, that would be a good reason to take an ARM because you're going to get a better interest rate while you're in that mortgage. Now, an ARM has two parts. You have your margin and your index. Your margin is the fixed component of the ARM. It will never change. A common margin is 2.5%. The index is what's variable. That's the part that can change. So what happens if we go back to my example of 7 years, at year 8, they're going to look at the margin, which is 2.5% in my example, and then they're going to go to the index at whatever the index is doing 8 years from now. There's a couple common indexes. One is the SOFR. The other one is some form of treasury bill, but they're going to look to see how that is trading. And so here in my example, let's say the index is 3% 8 years from now. So they're going to take the margin, 2.5, plus the index, 3, which means a total of 5.5%. That's going to be your interest rate for year 8 for that entire year. And then at year 9, they're going to do the same exercise again. They're going to take the margin, 2.5, and then they're going to look to see what the index is at that time. Add those two together, that's your interest rate for year 9. Which brings us to the next point, caps. So there are limitations on the ARMs. The ARMs can't just go crazy willy-nilly and just become whatever it's going to be. So typical caps you're going to see are 225. What that means is the first two that you see here is the maximum that the interest rate can change the first time. So going back to my example, if we have a 7-year ARM, at year 8, they're going to look at the margin, they're going to look at the index, and if I start at, let's say I started at 5.5%, the most it can change up to is 7.5, and the lowest it can change to is 3.5. So it's plus or minus 2%. There's a limit. The second number in this cap is the subsequent cap, which means year 9. So at year 9, we do the same exercise, and let's assume worst case scenario, I started at 5.5%. My first change date at year 8, it went up a full 2%, so now I'm at 7.5. Well, at year 9, they do the same calculation. Now the maximum it can change to is 9.5 or down to 5.5. Again, plus or minus 2%. And each year I'm going to do the same exercise. The third is what's called your lifetime cap. That means from beginning to end, your interest rate cannot change by more than 5%. So if I started at 5.5%, that means the maximum it could change to is 10.5%. Well, if I changed a full 2% the first year, a full 2% the second year, meaning year 8 and year 9, then at year 10, the most it could change at that point is 1 more percent, because I did 2, 2, the most is 1, because I'm going to hit my ceiling. So that's the worst case scenario. From lifetime, beginning to end, the maximum it can change is 5%. There are different variations. Sometimes you'll see what's called a 525. It just depends on which mortgage program you use. Now, just one last little tidbit here. Typically, if you pick a 5-year ARM, the bank to qualify you, because they don't know what the rate is going to do after the first 5 years, they're going to add 2% for what we call your qualifying rate. It is not the rate that you're going to pay, but they want to make sure that you can get qualified at 7.5%. So if the rate is 5.5, that's your note rate. They're going to qualify you. They're going to run your housing payment versus your income at 7.5 to make sure you got that buffer, that you're good, so that when and if interest rates do change, you can absorb that no problem, and they're not going to have to call you and say, hey, where's your mortgage payment?